Good morning, Brazil. My throat's a little dry, and raspy, but otherwise things are going good here. Gonna show you some interesting new things that we haven't shown you before. When it comes to what we were going to develop in terms of the intraday software, the some of the particulars weren't really well defined last time we talked. And this time we have a lot more really nice definition. And that's important because in the wonderful world of software, when you design something, it's important to be as specific as possible because software just doesn't go for kind of or sort of or stuff like that. So uh, anyway, we're doing a test run right now of a bunch of forex pairs. And what's unique about this test run is, first of all, it uses 5x leverage and does 1/3 of the position on each one-third of the total assets, and also uses multiple time frames. So it's not unusual to see a 60-minute time frame and then a second one that's a different time frame trade being signaled on the same day. And we're almost done. Here we are. And we can see what this test has done. It's a little bit over 2 years. Let's take a look at the picture. Okay, 59.5 on the annualized. And let's take a look at the chart. Pretty chart. Just been kind of up and stuff like that. Let's see, very important is the down draw. Let's see how the down draw has been with 5x. With 5x, it's been 4.94, and the CarMax DD, which is calculated annual return divided by maximum peak to low drawdown, is 12.04. The Sharpe ratio is 3.16 on long and short trades combined, but if you take long trades only, it's 5.51, which is a fairly interesting number. What's important here is that our exposure is ridiculously low of 18.49. And that means that we're only using our capital really 18.49% of the time. Okay, so that's what we've done in the wonderful world of computerized stuff. Um, and as you can see here, here we go. Here we have two trades on the 20th, and yeah, let's see if we have more of that. Two trades on the 10th. Let's see if we come down a little bit. Here we go. Here's one at, I guess it's at midnight and one at 1 a.m. And you can see there are two different values and have two different results. Okay. Sometimes when you have these trades, they both trigger at the same time when you have two different time frames being used with the same currency pair. Okay, let's move on to something else. Let's look at this one here. Okay, this is gold, and as you may recall, this morning I sent out a thing to the private group of the Andrews Group and emphasizing this reversal point here. So let's just do this properly. Yeah, it looks something like this here. So the whole idea was to suggest, hey, it's up we go time seriously now, folks. And I also drew in some other lines which were relevant. But what we're out to do is to do what I call precision trading, and we're really out to enter and possibly exit the market at very select times. Now, If you try to do this on a daily chart, it's really rough. You might get, in any one particular item like gold, you might get 1 or 2 trades a year. Terrible, terrible. However, if you're following, let's say you get 1 trade a year. If you're following 30 markets, then that gets to be 30 trades a year, which makes it a bit more interesting. However, if you're doing futures and you look at intraday time frames, let's say you get 5 times as many trades. That's 150 trades a year. If you can get 150 or 100 trades a year, that's a very good number. That's 100 trades a year is 2 a week. And with futures, your profit is typically per trade is typically higher if you're in it for a couple of days, and it's quite interesting. So we got long on this one here yesterday, and this is where we are. But let's take a look at some paper trades, pure paper. Let's get rid of this junk. Okay, there we go. So we can see here that this one here, we wound up getting along in the open yesterday, and the open is 53.33, which is really nothing. We're just pressing buy and sell on these things here as in order to kind of test out the concept in real time, not necessarily to make a ton of money, because after all, these are all simulated trades. They're not real. They're totally fake. Here's another one. There we go. Here's another one. And so this one wound up getting long right around here, and it's been up we go for a while. And so the whole idea is is with some reasonable amount of precision, recognize this here as a low, and then up we go until the next probable reversal point or something else that tells us it's a good time to get out. There we go. So these are 2 we've done in the last couple of days. So where do we have our buy here? 999.59, which would have been 999. Which would have been about here. Still, not bad. So this would have been our entry signal, and away we go. So looking for something that'll probably last in the way of 3, 4, 5 days maybe with this particular trade. And these are currency pairs, as you can see. So the benefit of currency pairs is that we get to see a variety of different things, and we can trade this all over the world. We don't have to worry about having access to U.S. markets. Okay. So that's what we're looking at. We're looking at intraday signals that are really precision trading oriented. That's the long and short of it. So I thank you for your time and see you next time.